Welcome to Investors Hangout. This fortnightly interaction to help you learn more about saving and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, with me, as always, is Dhirendra Kumar, the CEO of Value Research. Welcome, Dhiren.
Thank you.
Right. Now, Dhiren, exchange traded funds have been in the news lately for breaching the 1 lakh crore AUM mark. So, what's your view on their rapid growth?
Yeah, it is a very significant, large round number, 100,000 crore, and that is quite significant given that 5 years ago they started. But I think the primary driver has been Employee Provident Fund Organization, which where all the people in the private sector, their provident fund money is deducted and entrusted to them. They started investing in equity, and this happens to be the primary vehicle of their investment in equity. So this is a very significant thing because it democratizes ownership of equity ownership among a lot of people who would have otherwise never invested in equity. That's one. It's an institutional play. For EPFO, it is very difficult for EPFO to go about investing in mutual funds and choosing an actively managed fund, having an organization where a lot of people will be asking questions that why this fund, why not that fund, why this fund is also liquidity is a very significant thing to be able to. And during this period there is one more thing that has happened. ETF, the Nifty ETF, in which substantial amount of money is invested, or the Sensex ETF, they are liquid. They are largely invested in large caps, top 50 companies or top 30 companies, and they are the simplest vehicle for them. Also, the underlying liquidity is reasonable for EPFO's money to be deployed. I don't know, it's a chicken and egg story. Index funds or ETFs have, index fund ETFs are always mounted on an index, and when more money comes into index funds or ETFs, it also drives a self-fulfilling cycle, in a sense that more money getting into ETF, into the index, and index funds going up. So and because it's going up, so more money follows. That's one. The other is that EPFO kind of organization will be in great difficulty if a lot of people start pointing finger on why this fund, why that fund, or relative underperformance. Third thing is that large caps have been the primary driver of the market. We have seen that narrow Sensex or Nifty has been very narrowly driven. The 5-7 stocks have been the primary driver of this, and relative to other segments of the market. So these are the drivers, simple, easy to understand, and institutions are, nobody is going to be blamed for index not doing well, but an actively managed fund not doing well will, everybody will be pointing finger. So I think it's a great start. It's a good driver. It is a good vehicle. Also, because of the scale, the costs are very low. So as compared to the large cap fund, even very large sized large cap fund, their minimum cost will be 1 or 1.25%. This in itself, creates a 1% differential. The ETF, the actively managed fund has to deliver 1% more return to match the ETF. So the odds are against them. They have to do so, and the universe of investment is very narrow. At best, somebody, all large cap funds can invest in the top 100 stocks, and here they are investing in top 50, or the junior Nifty another 50, next 50. So I would say that it's a good vehicle for somebody who wants to keep it passive. Low cost, scale has added to the advantage. Institutional money coming in has also added to the liquidity. So good. So far, so good.
All right. So we've also been seeing a lot of interest in index funds and ETFs from among retail investors. So you were talking about how the EPF contributes a big chunk to the increase in AUM that we've been seeing. So what about just the investments of regular people? Is that also growing significantly?
Yeah, actually, substantial part of the money that has come into the largest ETF, the 100,000 crore fund that has poured in, a good part is institutional money. EPFO and a few other large institutional pooled investors investing in it. But I would say that yes, the general interest in ETF has also gone up simply because the large caps are doing well. Choosing a large cap which will beat the index is becoming difficult because very few of them are beating the index even now on a long-term basis. And the cost advantage remains. It is simple to invest, but it is not as simple as the normal mutual fund, the open-end mutual fund. I would say that if somebody is conversant with the stock market mechanism of how to place order, buy it as a demat account, and today you have a lot of something else has added to it, the simplification of the online trading mechanism. You have firms like Zerodha or Grow or Paytm Money coming up. They are enabling zero cost transaction to equity investors. And for somebody who wants to simplify, invest with great simplicity, without much of a friction, then these ETFs actually present a great value.
So, Dhiren, so far we've been talking about equity ETFs. However, recently a few debt ETFs have also made their way to the market. So, how do these work, and what is your view on them?
Uh, all ETFs must replicate an index. So there must be an index.
Right.
And because once you have an index, you don't need a fund manager, and that actually is the primary driver of uh, you know the low cost. You don't have to worry about somebody taking a decision in terms of money coming in. The mechanics of ETF, the way units get created, that somebody buys those securities, and that contributes to the creation of the units of the ETF. Uh, so there are funds which are replicating that fixed income index, but they don't have a long track record. And fixed income has its own, unlike equity, there is a fundamental difference in the character. Equity, when you buy shares, the assumption is that shares are for perpetuity. You are the owner of the stock, and the stock will remain in currency. Unlike debt ETFs, where when you buy a bond, the bond always comes with expiry. It has a maturity, it has a term, and of course the other dimension on which the bond prices move is the interest rate outlook and the maturity and the coupon on those securities and the credit quality of that, which is reflected in the credit rating. So I would say that these are early days. Low cost of ETF is a very is a charm. And I would say that the fixed income fund, the actively managed fixed income universe, is also very cost competitive. There, you don't have the, it's so competitive that fund companies actually reduce the cost of, the expense ratios of debt funds are very low. Many institutional investors who invest in the direct plan, I don't think they will have a significant cost differential, even with the ETF. Even active management can add some meaningful value. There could be a meaningful value in active management of a debt portfolio. But I would say these are early days. Let's see how it shapes up. I think replicating an index which is even simpler in terms of 10 year GUI, or uh, the standard bond or the index, which is in fixed income market the references are different. So I would say that let's see how it shapes up, allow it some time to evolve and prove its case. Uh, Good start, but I don't think compelling enough for somebody to really latch onto it.
So, Dhiren, you've already spoken about the relative merits and demerits of ETFs over actively managed funds. But for an investor now who's already decided to go with an ETF, what factors should they consider when choosing one, like when comparing among ETFs, among the various ones available?
Comparing among ETF, I think investors have just two things. It is very simple to evaluate that. One is the expense ratio, because that is going to be the biggest determinant of or biggest differentiator. If a fund has 10 basis point expense, or the largest ETF has 7 basis point, that's one. And the other is its ability to the tracking error, how closely it is able to do that. And I think third important thing for an individual investors will be the premium discount trend on the ETFs. When you have to buy ETF, you don't buy ETF. People, investors are used to buying mutual funds at NAV. That is the law. You put 10,000 rupee, and today, if you put your investment before 1:30 p.m. or 2:30 p.m., the cutoff time, you'll be allotted the units. based on today's evening NAV. So you don't
Right.
know what price your units will be allotted, but it
Right.
will be calculated in the evening, and it will be, the NAV, the 10,000 rupee divided by the NAV is the number of units that will be allotted. In case of ETF, you place an order, and ETF price can be little over, little higher or little lower. However insignificantly, it could be little higher or little lower than the NAV itself. So you have to see that what is the band of the premium or discount. If it is, if you are buying at little higher price or substantially higher price, it is not worth buying. You should be buying very close to the NAV, and that is the, and that, if it is higher than the NAV, then you should be very careful. If it is little lower than the NAV, then also be prepared that when you have to sell, you will not be able to realize the full NAV, but little lower than the NAV.
All
So
right.
these are three things which one should keep in mind: the cost, the tracking error, tracking error, the ability of the ETF to replicate the index performance, and third is the premium discount trend.
All right. So when the NEVs are released, they're released every evening. So suppose somebody is wanting to buy an ETF today, and they see the price on the market. How do they know at how much of a premium it is to the NEV when it's only? Do they compare to the previous day's NEV?
Yeah,
Sorry.
you only have the previous day's NAV, and you can actually get a sense of the direction of the market today.
All right. All right.
In fact, Sensex and Nifty is much easier because you can see the live Sensex and Nifty.
Okay.
Unfortunately, that is also not a very precise measure. You can only look at it from the percentage point of view, the directional, the direction part of it. Simply because these index are replicating something which is not the popular Nifty and index or Sensex that we see on the television or the newspaper. There is a variant of these indices, which is the total return index. So these index actually, the ETFs replicate the total return index. The total return index is, when you buy these 50 stocks of Nifty, you are also entitled for all the dividend that these stocks will be, because this is not just the raw Sensex or Nifty that we see. It is a very rough barometer. It is actually giving you a sense that, okay, of these 50 stocks, 30 went up, and on an aggregate based on the weight, it went up by 0.5%, 1%, or whatever,
All right.
500 points, 200 points, up or down, or whatever. In case of these Nifty ETFs, they will also be entitled for all the dividend that these companies will be giving. And that dividend on an annual basis could range between, anywhere in a very high up market or a sustained rising market, or a relatively expensive market. It could be 1%, and sometimes it can actually go up to over 2.5, 3%. That is a dividend yield on the Sensex or the Nifty. So broadly, you can say that, you can, the direction of today's market in comparison, and the reference should be yesterday's NAV, and look at the market price. You will get a very close sense of, whether you are buying it at a premium or a discount.
All right. Thanks, Dhiren. So we now move on to the questions that our viewers have sent us. And the first one here is from Anuj, and he asks, what is the difference between index funds and ETFs, and which of them is better?
Uh, Index funds, like open-end funds, you buy it at today's NAV. So you don't need to go to a stockbroker. You don't have to worry about premium discount. You give your money today's NAV. You will be allotted the units. When you want to sell, you sell it, like, you place your sell order and you get your money on a T+3 basis, like any ordinary mutual fund. The way these index funds are managed, they try to replicate the index in the best possible manner, but they might have some cash, and the tracking error will be higher than the ETF, simply because there is some money which is in transit in index funds always. When you give your 10,000, make your 10,000 rupees investment, the money doesn't get invested automatically. When you give the money is, even though the fund company would have received it, but it won't be invested at the same time. It might be invested tomorrow, and first it will be squared up with, the people. There will be some people who will be buying and some people who will be selling. That will be squared off, and depending on that, the index fund will either buy or sell securities in the same proportion as the index weight. Now, the fund company may not get precisely an amount which will be able to replicate that. So, there might be some small cash position which the fund might always have. So this leads to slightly higher tracking error. As compared to that, an ETF, as I explained earlier, that you have this, open a broker account with a broker, you will have a demat account, and you look for that ETF. It is available at a price which could be higher and lower than the NAV, and that range could be very nominal. And if it is a very wide range, don't get into that, because that is an avoidable ETF. Because if there's a huge premium or discount, maybe discount might be useful, but the problem of discount is that when you go to sell those units, to sell those ETFs later, then also it will be at a discount unless the trend changes or something significant, liquidity improves substantially. I would say that, if you want to keep it simple, of course, index funds have higher expenses. ETFs have lower expenses. But this is the primary difference, the way you buy it and the expenses and the tracking error.
Deepak writes in and he asks, should a retired person opt for ETFs to invest long-term money? And which index fund would be better between Nifty and Sensex funds?
They, in the long run, they mean about the same thing. 30 companies or 50 companies doesn't make much of a difference, and the 30 is actually a subset of the 50. And going by the weight, we see the performance largely very much in tandem. Even the long-term returns are not very different, and if it is different, it is very difficult to predict which one will actually do better. Sometime on a given time period, one or the other does little better than the other, but that doesn't mean anything. And so I would say that go with Nifty. It is a larger fund. Just go with the greater efficiency in the marketplace. And if it's a nominal premium discount and you are able to buy or sell anytime. But the first question, that whether one should invest in ETF, yes, if you are comfortable with the Zerodha app or the Grow app or Paytm Money stock buying mechanism, it's a zero cost. You are able to instantly diversify. You will be assured that you will do just as well, or just as well as the index, no more, no less. And if you're looking at a conservative position, 10, 15, 20% of your money to be invested in equity, you want to keep it simple. But at the same time, I would say that don't miss out on the basic principle of investing in equity. That even here, assuming that you are going to invest 10%, 20% of your total money, to give your overall investment its ability to beat inflation, then even here you should spread your investments over time. Spread it over the next 10 months, 11 months, 12 months, or 2 years, depending on the scale of money and the importance of money.
All right. So this next question is one that you actually answered in the discussion, but I'm just going to ask it anyway. So it comes from Rohit Yadav, and he asks, why do some index funds have more return than other index funds, even though they follow the same index?
Yeah, there could be difference. As I was saying that, the tracking error, if I'm referring to the open-end debt funds, open-end ETFs. And the open-end ETFs, this could be entirely because of, the tracking error and the expenses. Though the expenses of index fund is lower than an actively managed fund, but still, some fund companies can charge high or low. If a fund company is actually charging 25 basis point as compared to 50 basis point by the other one, then this itself will be a critical difference. Right. Then, depending on the scale, how efficiently the fund is able to replicate the index. So, how good the fund is in terms of replicating the index will translate into a tracking error, and that will lead to the divergence in performance.
Now, Ajay, he writes in and he asks, what is the reason that most ETFs and index funds are in the large cap space only? And why don't we have them in the mid or small cap space?
Yeah, there's some small beginning. Some fund companies are getting started with their small cap and mid cap index ETFs and index funds as well. But I remember, long time ago, about 10, 15 years ago, Benchmark launched, the erstwhile, Benchmark, which now eventually got transformed into Reliance Mutual, now Reliance Nippon. They started a BSE 500 index. And BSE 500 index was a very difficult index because replicating that index was very difficult. There used to be about 50 stocks in which if the fund got about 15 to 20 crore rupees of incremental money in a month, the fund was unable to buy those stocks. So the absence of liquidity in the underlying stocks, Nifty and Sensex is easy to do because these top 50 companies or top 30 companies, the FIIs buy it, there is enough liquidity. If the funds are getting 50 crore, 100 crore to 500 crore on a daily basis, they can still deploy it. It is very difficult to deploy that kind of money in the small cap and the mid cap index, because so far the mid cap and the small cap index, they had absolutely no connection with the reality, and even now I don't think they have, because they are just they're just supposed to be a barometer. How are the index doing? How are these stocks doing in general? That is just to get a sense of that. But they are not designed in a manner that one should be able to invest in those index in exactly the same proportion. And maybe for 5 crore, 10 crore, 25 crore, it can be done, but without much of an impact cost, because that is another significant thing. When you go to buy a small company stock in large quantity, that action of buying in large quantity of a small stock which will have low liquidity itself will drive up the index. That will have an impact cost which could be quite substantial, and it could be at the time of buying and it could be at the time of selling as well. So we have to see, it is a chicken and egg story. Till we have more money in such index funds, or those index funds get created, there won't be liquidity. Also, I feel that Indian small cap and mid cap universe, many companies where promoters have a very significant holding, and there is just not enough liquidity in the market, or there is not enough supply in the market. Even if price goes up, there are not too many sellers. I know of companies which are 5,000 crore capitalization or 7,000 crore capitalization, but it is extremely difficult to buy stocks worth a crore of rupees every day. Their daily liquidity can, so small investors might have an advantage that they can put their 1 lakh, 5 lakh, 50,000 rupees on a daily basis in such stocks. But for an index fund, for a meaningful amount of money, that will not be, it's difficult to replicate. So my sense is that such ETFs will be very hard to run. Open-end small cap index funds might still be possible, but beyond a certain scale, unless the underlying liquidity actually rises or grows substantially, it will not be possible. And let us see, there is a modest beginning with the launch of some of these small cap index funds. Let's see how it shapes up.
So this next question is from Amit, and he says, I'm 46 and planning to retire in 3 to 4 years. Would it be better to purchase a personal health insurance policy now in addition to the employer-provided group health policy, or should I purchase it post-retirement?
Yeah, I think you can have a supplementary health insurance policy, and when you retire, actually enhance the value or the coverage. And if you have 2-3 years of no claim, the coverage itself, the value of coverage also gets increases over time. And you will also be able to build a track record with the insurance company in terms of your health track record, and your claims uh, entitlement, or have you availed it or not. But if you do take it after retirement, you will not be, you don't have any significant cost advantage, because health insurance pricing entirely depends on, it gets revised every year. There is no advantage of buying it early.
Now, Hashavardhan Vaidya, he writes in and says, since the markets are volatile and may continue like that for a year or so, would you recommend investing in arbitrage funds to generate good returns?
Markets are always volatile, and I don't think you will come across a stage where markets are not volatile. That is the nature of this. That's the nature. So I would say that don't be guided by don't try to avoid the crisis, or the volatility. You should be primarily guided by when how long is your money to be invested. If this money you are unlikely to need for 5 years, 10 years, then maybe start your gradual investment. Maybe start conservatively, start investing in equity income fund. That these funds are a quarter or a third of the money is in equity, remaining 2/3 is in fixed income. If you definitely need the money in 1 or 2 years or 3 years, then you have this option. Arbitrage fund is one, liquid fund is another, and maybe more appropriate fixed income category which will enhance return, which is very much in line with your time frame of investment. That should be the basis of choice of your fixed income fund for investment in for short term and medium term. Long term investment, you should have some equity exposure, small allocation, and when investing in any kind of equity, you should spread your investment. over time.
All right. All right. Okay, so we have another investor here who's worried about the current market situation, and Sharda Murali, and she writes, considering the current market scenario, would you suggest taking the money out and sitting on cash? I have a horizon of about 5 years.
No. If you would have asked me in March, when everybody was so scared, one would have missed, one would have made all the losses permanent, and one would have missed the big rally that came soon after the big decline, big dip. Uh, there is a possibility that my advice will hurt you in the short run, but I'm confident that over a 5-year period, you will not have much of a regret. I would like to, suggest one thing. If your money is entirely into equity, and you have a time frame of just 5 years, make sure that you are making your investment little conservative. It is 100% into equity. Maybe move your money to aggressive hybrid funds. That way, a third of your money will be in fixed income. In a market fall or a substantial market fall in a brief period of time, they will not crumble as strongly or as freely as the market. So you will be able to build some shock absorber, and this is a natural way of having a asset allocation, which is little not having 100% equity, or take a third of your money, move that money into fixed income. Because the problem of taking all your money out and waiting for that correction is that you just might keep waiting. You'll miss on a big opportunity. You just might have great regret, and you still have time, enough time. And in a 5-year time frame, I'm confident that markets should do better. And whether the market will come down or not, it's very difficult to guess.
All right. Now, Arun Kochar, he writes and says, what is the importance of yield to maturity while investing in a corporate bond fund, and how should I use it to decide on investing in a particular fund?
Yield to maturity is, when you buy a fund, uh, buy a bond, and if you hold till its maturity, what will be the return? Simply put, this is what it is. So, yeah, if the yield to maturity on a fund portfolio is 8%, then you can safely assume that if all investors remain constant and the fund manager does nothing, the yield to maturity minus expenses will be your return on the fund. But that is not the reality. Other investors come in, interest rate outlook changes, the fund manager makes changes in his portfolio, and there is a deduction of expense on a daily basis from the debt fund. So depending on all these variables, the return could change, but yield to maturity on a fund portfolio is an indication that what is the return of the bonds which the fund is holding as of now. Things might change, but your expectation of return from such a fund should be around that range, adjusted for expense.
All right. So we have one last question, and it's from Bindu Mohan Kumar, and he asks, what are ESG funds, and would you recommend investing in them?
ESG funds actually are, funds which focus on companies which are more stringently compliant with, environmental, social, and corporate, with high corporate governance. And they keep away from companies which, polluting companies, or which are not environment friendly, where there is no high, and they have measurement. There are yardsticks on which they measure the corporate governance, the conduct of the management, and these kind of this investment strategy has been very popular abroad. So even though in India it has not it has not gained popularity, but it is having an impact on the Indian market, because the foreign investors who invest their money in India, a lot of that money is coming from those ESG funds, and those funds cannot invest in those companies which are not compliant with the standards or the definitions of the ESG. So that is why we see that there are well-performing companies which are not very high on the ESG standard, or they don't actually qualify, are not part of their investment universe, and they are out of favor. And uh, I can particularly refer to ITC and public sector, many public sector companies, Indian public sector companies, which are relatively cheap despite a buoyant uh, markets, entirely because of this. In India, it is just beginning. Some fund companies have launched their ESG funds, early days, but simply going by the mandate, it also turns out to be a sound investment strategy. We have seen it in the past. There are two Sharia compliant funds, and they have good performance simply because these companies avoid companies with high debt. these companies keep away from companies, these funds keep away from those companies which are, investing the alcohol business and this and that, and and particularly banks, and that has come in handy. That also turns out to be companies with low debt. That also turns out to be a sound strategy. I would say that ESG also is a similar case, or maybe a stronger case, that high corporate governance, social compliance, or with a social standing, or sensitivity, and environmental friendliness. This can also be, well, could be good driver of sound companies and sound management.
Okay. To all our viewers, thank you so much for tuning in, and bye for now.